Today we are going to conduct financial statement analysis on Amazon and see the back of envelope valuation results, and also take a look at 7 moonshots that's embedded within Amazon. Let's start with revenue, which increased sevenfold in the past 10 years from $135 billion to over $700 billion in 2025. This is CAGR of 21%, which is very satisfactory, but if we just look at 2025, total revenue only grew 12%. And is this slowing growth a problem for Amazon? In order to find out, let's divide the revenue into 7 segments and start with the first-party revenue, which is the largest segment. Problem here is that this revenue only grew about 6% per year in the past 5 years, which is very low for a tech company. So in order to see how big a problem this is, let's take a look at the GMV. But as we can see here, the total GMV grew at about 20% per year and had solid growth in 2025. But what's more important is the breakdown of this GMV. This purple line shows the proportion of 1P revenue in the GMV, and orange line is the third-party GMV. So the 1P GMV proportion decreased from 62% in 2011 to less than 30% last year. And in contrast, third-party GMV increased from less than 40% to over 70% in 2025. And this trend is actually good for shareholders because third-party GMV has much higher margin and ROIC. And within this third-party GMV, the portion that goes to Amazon as revenue increased from 8% in 2021 to over 10% in 2025. Here, the trend is definitely positive, but the problem is third-party GMV can only grow up to 100% as its high limit, and the portion that Amazon takes from its sellers cannot go up much higher because there are competition from other e-commerce platforms. But another bright spot in e-commerce is advertising. This segment grew almost 30% per year and has very high margin because it's only providing services for the third-party sellers. Within Amazon's consumer business, the most important part is these subscription services, which grew at a decent pace of 14.5% per year for the past 5 years. And this portion is important because this membership revenue is very sticky and has high margin as well as customer lock-in effect. For example, if someone joins Amazon Prime membership, that person will probably spend more time and money on Amazon platform. Now let's move on to the enterprise business known as AWS. This business grew 23% over the past 5 years, and in just 2025, it grew almost by 20%. And the management shared that the growth could have been higher, but there are constraints coming from the lack of semiconductors as well as electricity, limiting the data center capacity. So as these issues get resolved over the years, AWS growth can definitely pick up. And the higher demand over constrained supply can also be shown in the operating margin. As we can see here, before the AI boom, AWS generated about 25 to less than 30% return. But as the demand is higher than supply in recent years, the margin has increased to above 35% for the past 2 years. Now let's move on to the profit section and see how Amazon's profit is shifting into the new paradigm. Taking a step back, we can divide the past 30 years of operating profit into 3 stages. The first is until the early 2000s, where Amazon had very high growth but generated losses during those years. In the second phase, while still maintaining high growth, the company started generating profit, although it was small. During these ups and downs, Amazon never surpassed $2 billion profit, but as AWS started generating profit, it started generating tens of billions of dollars while still maintaining decent growth. However, as we can see here, starting in the past 2 years, Amazon has entered into a new phase where EBIT growth is very substantial despite lower growth. And the lower growth can also be shown in the graph, and here I also indicated the 3 stages as discussed. And on the far right, we can see that at current stages, we can only expect 10 to 20% revenue growth from Amazon. But to see how high the profit can grow over the slowing growth of revenue, let's divide the Amazon's EBIT into 2 parts. So the blue part here shows the profit coming from AWS, and this is 80% of the total profit. And the orange part shows operating profit coming from retail business. This part is much more volatile, but we need to take a deeper look at this. Let's first divide this e-commerce business into 2 parts, USA and international. As we can see here, US contributes about 60% of revenue, and the rest comes from various countries around the world, led by Germany, UK, and Japan. And although the developed countries are having about 15% revenue growth, the growth is much higher still coming from developing countries. And so this retail profit should be divided between the US and international. The black line here shows profit from the US business, which is definitely higher compared to the international shown in the blue line. What's more important is the gap between these two. Before COVID, there was about 7.2% gap between the profit coming from North America and international. But in the past few years, this gap has decreased to 4.9%, and last year it was only 4%. So as this gap narrows over the years and international business become more profitable, we can expect higher EBIT coming from the overall retail business. This is very important, so in the later section, we will actually calculate the valuation impact of this change, which is positive for shareholders. And for now, let's move on to the elephant in the room, which is Capex of the hyperscalers. As we can see here, the market is very concerned about big tech companies investing very heavily in the AI era. And Amazon is leading the charge with its $200 billion Capex for 2026 alone. And this large Capex is making people nervous because there's a big question mark about the return that can come out of it. So let's break down Amazon ROIC into AWS and retail. And as we can see here, AWS used to generate very high 45% ROIC before the AI era. However, in the past few years, as the investment increased, this return has decreased to 32%. So these two can actually be our scenarios where 45% return to pre-AI era can be the bullish case, and current 32% can be the base case. And for the retail business, as mentioned before, we should divide this into North America and international. And for North America, in the bullish case, we can assume that the ROIC will go back to the pre-COVID era of 31%. And for the base case, we can assume that current lower ROIC will continue into the future. And for the international business, it has been creating losses for the most of past decade. But as we can see, it started generating profit 2 years ago. So going forward, we can assume that international business catch up with the US one. Or we can assume its lower ROIC will continue into the future. So for the bullish scenario, we can gather these more positive numbers, calculate, and see that Amazon's equity value in this case is about $4.6 trillion, which is 108% upside in about 2 years. So for yearly basis, it will be about 50%, which is of course very high. But if you look at more conservative base case numbers, the equity value will be $2.9 trillion, which is 28% upside in 2 years. This is about 13 to 14% year return, which is not eye-popping, but still pretty decent. But of course, what the market is worried about is not this base case, but the AI bubble actually bursting. So here I assume that for 2 years in a row, Amazon continues to invest very high capex as the management is planning. But instead of the high returns that it has generated before, I assumed that it only generates very low 5% ROIC. So if the cloud business is suffering significant slowdown because the AI is not performing as expected, and in this case, I'm assuming bull case for the retail business, and also applied multiple contraction, lower than the Amazon's historical averages. In this case, Amazon's equity value is less than $2 trillion and indicates the shareholders will lose a total of 11% even if they wait for 2 years. So these are the 3 scenarios that are calculated from these back-of-envelope valuation exercises. But there is another piece that shareholders should be aware of, which is R&D. Because Amazon is investing very aggressively, not just in the capex, but in the R&D expense as we can see in this graph. Amazon's R&D is 83% higher than Microsoft and Meta's, and compared to Apple and Google, it is 3 times higher. And compared to Nvidia, it has 6 times higher R&D expenses. And this trend is not just in 2025, but as you can see here, it has been going on for several years. But this has not always been the case. So as we see, in 2012, Amazon had less than half of Google's R&D expenses. But as it started the cloud business in 2015, the R&D became comparable between Google, Microsoft, and Amazon. But as the years passed along, Amazon is becoming more and more aggressive, and the trend is very clear that it is spending much more than its cloud competitors. But since Amazon has businesses other than its cloud, let's start with its e-commerce business and how much it's spending on its R&D. Looking at other e-commerce peers from eBay, Shopify, Sea, and Melli, they're spending about $1 billion to $1.5 billion in R&D expenses. And even Amazon, before it started its cloud business, spent about $2 billion. So going forward, we can assume this is how much Amazon spends. And in terms of streaming contents, because this cost is included in the R&D, I compared with Netflix, Paramount, and Warner Brothers content costs. Warner Brothers had the highest number, which was about $20 billion, which I applied the same number to Amazon. So since Amazon has $108 billion of total expenses, if I exclude this retail and content investment, the rest is about $86 billion. But this is still much higher than Google and Microsoft's investment into cloud. If we see this in a graph, even if we exclude the retail and content costs, Amazon is spending very heavily. So in order to better quantify this, I'm subtracting Microsoft's R&D expenses out of this $86 billion and get the difference, which is about $25 billion. So we can assume that Amazon spends about $60 billion in terms of its cloud and other enterprise businesses, and about $25 billion for its other optional investments. And for these, we can call them even moonshots because they have very high upsides but pretty low chance of success. And let's quickly run through each of these with my personal assessment. First is Amazon Health Services, which is utilizing the inefficiencies, especially in the healthcare system of the US. And because this can be combined with its Prime membership, I think this has positive long-term prospect. But what has bigger impact will be the moonshot businesses that's related to Amazon's retail business, starting with its robotics and physical AI business. Here, because Amazon can directly apply these technologies into its warehouses, I think there's pretty high chance that Amazon will become one of the top players. And related to this is the Zoox, the autonomous car business. Although standing alone, this business might not look very differentiated from other competitors. But since Amazon already has thousands of trucks moving all over the world to deliver products, I think there can be pretty big synergy once this becomes more mainstream. Next is a drone delivery business, which can also work with the e-commerce and Prime memberships. But here, I think the upside from this business will not be as big as compared to other businesses that we saw before. Amazon One, or Just Walk Out Frictionless Retail, is another moonshot project. Although Amazon was pretty aggressive with this by launching several physical stores, it seems pretty unclear how this will move along because Amazon started closing down physical stores with this system on. Next is Alexa, which also has been on and off, but here it's hard to see Amazon becoming competitive because its LLM seem not as formidable compared to other AI companies leading the market right now. And finally, Amazon's space business, which is renamed to Amazon Leo, started launching its satellites aggressively starting in 2026. Although this is a long-term project, because SpaceX is going public this year, it can get a lot of investors' attention if it progresses according to its plan. So as we can see, there are 7 projects and perhaps even more that we don't know about, then Amazon continues to invest in billions of dollars. They're getting less attention compared to Meta's aggressive investment into its metaverse and AI projects. But as we saw in the numbers before, Amazon has these 7 moonshot projects embedded in its financial statements. So that's it for today's analysis. And if you want to take a look at the result of detailed financial model of Amazon and how I am trading these AI names, please check out the link below the video where you can get the information. Thanks for watching, and I'll see you guys in the next video.